All right, this is exercise 17-3, temporary differences, deferred tax liability, and permanent differences. So this will be our first problem introduction to a permanent difference. We've got Cynthia Manufacturing Incorporated reported pre-tax book income of $3,250,000 for the current year. The change in the difference in the basis of plant assets is 430,000. The book basis is higher than the tax basis. That means that our depreciation for tax purposes has been accelerated. Of Cynthia's pre-tax book income, $12,000 is non-taxable income from municipal bonds. At the beginning of the current year, Cynthia's estimated warranty liability had a balance of $67,000. Actual repairs cost $55,000, and the company accrued an additional $72,000 for the year. Cynthia paid fines of $100,000 to the federal government for not complying with relevant regulations. Prepare the journal entry required to record the tax expense for the current year, assuming a 40% income tax rate. All right, so let's start off with the pre-tax book income, and we'll go back to our way of book income first, and that was $3,250,000, and we start in the same place for tax, $3,250,000. All right, so now what we're going to do is we need to take out the permanent differences first. Okay, so the permanent differences, change in the difference of the plant basis is plant asset is 430,000. Okay, so that's going to be a temporary difference, and so we're going to hold on to that for a minute. The pre-tax book income, 12,000 is non-taxable income from municipal bonds. So we're going to take that out from both sides. Okay. And then the next one, at the beginning of the current year, the estimated warranty liability had a balance of 67,000. Actual repairs cost 55,000, and the company accrued an additional 72,000 for the current year. So what we want to do is we want to take that. We're going to go down here and get a little piece of scrap paper, and we're going to take the 72,000 and the 55,000. Now this is a temporary difference, so I'm kind of doing this a little bit early. And the 55,000. Okay, so the difference there is going to be 17,000, right? Let me check that. Yeah, 17,000. Now, what we'll end up doing, this is going to be a temporary difference, so we'll talk about that in a minute, but I will add that to the tax because the book income already reflects that accrual, right? Okay, Cynthia paid fines of $100,000 to the federal government for not complying with relative regulations. Fines are included in pre-tax book income. So what we need to do is we need to add that back to both sides now. And that takes care of all of our permanent differences. So 3,250,000 minus 12,000 plus 100,000. We get 3,338,000 for both. All right. So now after we get done with the permanent differences, that's when we figure our tax expense for book purposes. So we're going to multiply this number times the 40%. And we see that our tax expense is going to be $1,335,200. Okay, now what we have to do is take care of the temporary differences for tax purposes. So our first one up there, the change in the difference of plant assets is $430,000. The book basis is higher than the tax basis. That means that our tax depreciation was $430 higher. So we're going to subtract $430 out of that. So $3,338,000 and 430 minus that will give us $2,908,000. Now we come over here. Remembering for tax purposes, we can only take warranty expense as it's actually incurred. So that was the $55,000. But we booked an additional $72,000 this year. So what we need to do is we need to add an additional $17,000 into the tax. That gives us $2,925,000. Now we multiply that times our tax rate of 40%, gives us $1,170,000. We're now ready to make our journal entries. So our tax expense is the $1,335,200 for book purposes. Our taxes payable is $1,170,000, and the difference between those two is going to be $165,200. Now we have no indication that there is a that there was already a deferred tax liability or an asset on the books. So this will be deferred tax liability. Remember, when we are increasing the deferred tax liability, it's going to be a credit, and when we're reversing or reducing the deferred tax liability, it will be a debit. So, but you can always check that by making sure that the entry balances, right? So that is exercise 17-3.